Hey everybody, this is Julian here. Welcome to the webcast. This is your 2-minute warning. We'll be starting the webcast in a couple minutes. So just hang out for a bit and we'll start soon. All right, welcome ladies and gents to the webcast today. We're talking about merger arbitrage, which is a strategy for consistent return. So a lot to talk about. I'm going to try to run through this presentation relatively quickly. Feel free to ask questions into the question bar and we'll get to your questions at the end of it. So make sure to read this disclaimer and we'll start with the presentation. And I like starting this with one of my favorite quotes by Warren Buffett. He said, "Give a man a fish and you'll feed him for a day. Teach a man to arbitrage and you will feed him forever." I believe this came from his 1989 shareholders report to Berkshire Hathaway investors. And really, if you go through his investing history, really the track record of probably the greatest investor of all time, he relied on merger arbitrage pretty extensively throughout his career. Specifically in 1988, I believe Berkshire Hathaway earned over 50% off of their arbitrage investments. But nonetheless, it's a strategy that has basically been done for nearly 100 years. It's a strategy that Ben Graham would use in his Graham-Newman partnership back, I believe, in the 1930s, 40s, 50s, and that's when Warren Buffett joined the Graham-Newman partnership prior to starting his own hedge fund. And when Buffett started his first firm, the Buffett Partnership, he basically had two rules to investing. The first is never lose money, and the second rule was never forget rule number one. And he went on to establish just a great track record, outperforming the market while really not having any down years. And one way he did that was through arbitrage strategies. So he's been doing arbitrage for many, many decades, and it served him very well. And it served a lot of investors very well. And it's a strategy that I'm going to tell you more about today. But starting off with the basics, what exactly is arbitrage? Easy example of arbitrage would be retail arbitrage, where say there's a price discrepancy between Walmart.com and Amazon.com. You can buy instantaneously on one platform and sell at a higher price instantaneously on another platform, basically locking in that arbitrage spread. the theoretical definition implies that arbitrage is a risk-free proposition, but in a practical sense, there is risk involved. Another easy example would be interlisted arbitrage, in which, say, you have a stock that's traded in both Canada and US. For example, Royal Bank stock, it trades on Toronto and in New York. There are high-frequency traders that are keeping those prices in line, looking to make a penny or so off the spread between buying in Canada, selling in the US, or vice versa. So that's interlisted arbitrage. However, today we're talking about one of the most popular forms of financial arbitrage, and that is merger arbitrage. So what is merger arbitrage? It's basically capitalizing on the spread between a company's share price in the market and that of a consideration paid for the company in the context of an announced merger transaction. So everyone would know what the company is being taken out for. It has been publicly announced and it's known in the market. However, the shares typically trade at a discount to that consideration just to account for the deal potentially not going through, in addition to time value of money. So basically what a merger arbitrager is looking to do is to generate yield, generate profits by buying takeover stocks at discounts to the acquisition price, basically capitalizing on what's known as the merger risk premium, which is a premium offered in the market to compensate ARBs for the risk of a deal failing to close, in addition to the time value of money. And when we put all of these merger arbitrage investments together, the goal is to have a diversified merger arbitrage portfolio aiming to generate a return in excess of cash, call it 300 to 500 basis points in a normal environment. Obviously, in this current COVID-19 environment, things are far from normal. The market's going a little wacky, so we're seeing significantly wider spreads, which is something I am going to touch on later in this presentation. The basics on how merger arbitrage works, there's generally two types of considerations offered to target shareholders in the context of an announced M&A transaction. The first one, really easy, is a all cash consideration. What you would do here, if you're looking to earn that merger arbitrage spread, is basically buy the target stock in the market at the price, the discount it's trading to, versus the cash consideration offered that you'll receive once the deal closes. The second type of consideration is either all stock or a stock and cash deal. Now, this one's a little trickier for an arbitrager to execute. You do the same thing, you buy the target stock at a discount to the consideration, but here we need to hedge the consideration because the consideration is made up of stock. So we got to go into the market and short the acquirer's stock at the designated exchange ratio, as it's spelled out in the merger agreement, just in order to really lock in that spread, because the acquirer's stock is going to move around with the market, right? And the goal of an arbitrager is not to have any market exposure. We're really looking to lock in that spread. Easy to do on a cash consideration because it won't move around, but more tricky to do when there's stock offered as part of the consideration, where you actually have to go out. Typically, this is done with the use of a pairs trader. You'll go long the target and short the acquirer at the same time to minimize any market risk with respect to that spread. Go through an example here. This M&A example, this merger arbitrage example, is that of IBM's acquisition of Red Hat, which was announced in late 2018. If you look at the blue line on the right, the blue line is Red Hat's historical share price. You can see in October, it was around $120 and change. On a Sunday evening over a weekend, IBM and Red Hat announced a friendly deal where IBM would acquire Red Hat for the consideration of $190 per share, which is quite the premium to the $120 per share, north of 50%. So on Monday, Red Hat shares obviously rallied up, but they did not, as you can see, they did not hit the $190 per share. they actually settled at 169 and change on the first day. And so you had a spread, that arbitrage spread there shown in green, the difference between the share price and the consideration offered in orange, that was north of $20 per share, or 12%. And as you can see over time, the red hat share price meanders slowly and slowly higher as more and more conditions of the deal get satisfied. And then ultimately, after 253 days, the deal closed. Holders of red hot stock get paid 190 per share, and an arbitrager would earn that 12% return over 253 days. Now, this equates to nearly an 18% annualized return, and the goal is to earn this return irrespective of what's going on with equity markets or credit markets, interest rates, currencies, etc. Really looking for a portfolio of uncorrelated trades such as this. Wanted to touch on where the returns of merger arbitrage come from. It's always a question, how do you generate these returns, and what sort of justifies this? Well, if we look at investing in a general sense for stock investors, you earn what's called an equity risk premium. If we rewind back to 2019, you had low volatility, high returns. You really weren't taking much risk to earn very good returns. However, if we go to the current environment in 2020, we're dealing with massive volatility. So long-term investors are really earning that equity risk premium, which is basically the additional return above the risk-free rate that an equity investor would need to be compensated for withstanding that sort of volatility. Credit investors, you see the same thing. If you're investing in corporate credit, there's a default risk premium, which is also rearing its ugly head in this environment as credit spreads widen. So how merger arbitragers earn yield is just through the merger risk premium. Basically, that compensates investors for the risk of a deal falling apart, in addition to the time value of money, which admittedly this day in age is quite low, given where the risk-free rate is these days. However, that merger risk premium really manifests itself through that spread that an arbitrager earns on a merger arbitrage investment. So where we're getting compensated here is the merger risk premium, which is analogous to other existing risk premia in the market. Now we're going to get into how we put together a portfolio of merger arbitrage investments to create the strategy, the exposure that the strategy provides. Now it's a really complex investment strategy. It requires a unique combination of various skills, experience, and knowledge, everything from financial to legal, antitrust. You kind of got to be a detective. However, it's a fairly standardized strategy, and it can be executed systematically, which is what we try to do. And what we show on the right side of the slide here is basically a systematic checklist that we go through when evaluating a potential merger arbitrage investment. So number one, say a deal gets announced in the morning. Where you start is the press release from the target. Typically, the acquirer and target will come out with a joint press release, or occasionally they do come out with separate press releases, of which we would be required to read. So number one, what are the deal terms? What is the acquirer offering to the target? Is it an all-cash deal? Is it cash and shares, all shares? What's the premium? What's the valuation? Is it friendly or hostile? Is it definitive? What's the timing? Is it expected to close, in 2 quarters? Is it expected to close next year? What are all the conditions on the deal? So you find that you start on the initial press release, and from there, sometimes they do have a deal call, conference call that you can tune into to perhaps pick up more information. You'll look at the investor presentation, then they start releasing more documentation, start filing it with the regulators. SEC in the US and the Canadian regulators in Canada. Specifically, they'll file the merger agreement, which details additional things you should know about the deal, more details on the conditions, etc. So we want to upload basically all the key terms of the deal into our database. Now we've been keeping track of deals for over 10 years now. So we have a vast database of over, I believe, 3,000 M&A transactions that we've analyzed and many that we've invested in. And that really helps when creating a systematic process, is if you have it, detailed in a model. So certainly note all the major deal terms. That's your first step. Then off to target due diligence. So there's a number of ways that a deal can break. So we're really looking for red flags here. Number one, you take a look at the shareholder list of the target. In the deal documents, they'll generally say if there is a big shareholder, have they locked up their shares, i.e. have they agreed to vote for the transaction or tender their shares in the case of a tender offer or takeover bid. So it's really important to see any potential blocking shareholders, or if there are large shareholders, have they agreed to support the deal. In addition to the target due diligence, especially in this day and age, you want to look at cyclicality, balance sheet strength, financial resources, financial performance, things of that nature. Then on the other side, you move on to acquire due diligence. Most important thing here is if it's an all-cash deal, do they have the money? What sort of risk is there involved in the financing? Do they have the financing all sealed up, committed financing through legitimate and credible banks, or is the deal subject to financing? Because that certainly increases deal risk pretty dramatically. So look at anything on the acquirer side, specifically financing, that's most important. Always check if there's a vote at the acquirer side of things, because that could be a potential huge red flag as well, which I can get into if you'd like. So once we've completed the major deal terms, we've uploaded that into our model, we've done our target and acquire due diligence, specifically on shareholders, financing risk, etc. We'll want to look at specific risks that a sector could trouble the deal. Specifically, say you had an oil and gas deal. Well, what happened with the price of oil over the past month would really put energy deals in jeopardy, just given the dramatic downturn in that sector. So you want to be aware of specific sector risks. You want to diversify your portfolio such that you are broadly diversified across sectors, and be aware of various risks that each specific sector of a M&A deal can give exposure to. Specifically, financial and technology deals, they're highly regulated, so you'll want to be aware of that. Then more commodities-based deals, materials, oil and gas, you got to keep your eye on commodity prices, etc. And then after that, regulatory due diligence. If a deal is subject to antitrust approval in the US, it's DOJ, Department of Justice, or FTC, Federal Trade Commission. Up in Canada, you have the Competition Bureau. There's many global deals require many antitrust regulatory approvals across the globe, whether it be European Commission or the Chinese antitrust approvals, or anywhere from Germany to Turkey to Mexico. Really depends on where the target and acquirer are doing business. So be aware of antitrust regulatory regime. In addition to foreign investment regulatory regime in the US, there's a process called CFIUS, in which international or foreign investors need to get approval from the US government to acquire a US company. And a similar thing in Canada, where you have Investment Canada process, in which the government evaluates deals. If we go back a couple of years ago, Industry Canada, they blocked the Chinese acquisition of a company called Aecon. They're just a construction company, but the Canadian government deemed it a security risk, so they ended up blocking a deal. It is rare, but it does happen, so be aware of those regulatory issues. Then we're gonna next talk about trading. If it is an all-share deal, this means that we have to go out and short the acquirer's stock. And before we short it, we got to short borrow, i.e. we got to borrow the shares prior to shorting it. So we don't want to be shorting difficult to borrow securities, or if the borrow rate's very, very high. So that's another thing to consider. And lastly, if all the boxes are checked on this checklist, then we can consider trading it, create the best trading strategy. Typically, we like to be passive. Passive means, sitting on the bid, waiting to get filled, as opposed to crossing the bid-ask spread, which just increases the yield that you can generate on that trade. Also, if it is a share consideration, you'd want to use a pair trader such that you are minimizing the market risk between where you put on your long and where you put on your short. Some ARBs like to market make. Say there's a deal that has a 5-cent spread. Well, you can bid at 5 cents, sell at 3 cents, and try to generate extra yield from that. So that's another thing to kind of consider is a bit of a market making activity on any deal spreads if you'd like to try to generate additional yield on top of it. But nonetheless, have a checklist, have a systematic process, and note that the strategy really requires a pretty diverse toolkit, but it's something that's really generated with experience. So once we've gone through our checklist, we can really see if a merger arbitrage investment justifies a position in the portfolio. If it checks all the boxes, we can say, okay, it checks all the boxes, we can now consider it to be part of the portfolio. And so now here we have to actually evaluate it from more of a financial perspective. And here we look at 3 major things. The first is attractive annualized return. It's got to have a good yield. Specifically, it's got to reward us for the risk that we're taking. And number 2 is generate a return above our cost of capital. So say you borrow at 2% or so, you're going to expect a return above 2%, or else it's just not worthwhile because the requisite yield is not there. So most important thing, attractive annualized return. Then you want to look at the market implied odds of success. So you look at the upside and downside. So say stock's getting taken out at 100 and trading at 90. So you got $10 upside, but say you got $40 downside. If it breaks, it goes down to 50. So 10 up, 40 down. You got to consider those odds. And if those odds, in your opinion, those offer an attractive acquisition from a expected value perspective. And lastly, you want to make sure that this return won't be dependent on what the market does. So you're looking for ultimately uncorrelated trades here, idiosyncratic that are uncorrelated to what's going on elsewhere. Obviously, we can't invest in a vacuum, and at the end of the day, when crap hits the fan, most things become correlated where they're unexpected to be elsewhere. But nonetheless, it's something worthwhile considering is to minimize correlation, which is why we typically don't participate in non-definitive deals, because if you look at something over the past month, say Navistar, which is non-definitive, they just had an offer out there. Well, those go away pretty quickly if the buyer isn't subject to any the obligations of a definitive agreement, which are in fact very, very difficult to walk away from. If it's a non-definitive deal, the buyer can just walk very, very easily. Same thing on a hostile acquisition. Those tend to have higher beta, higher market exposure. We saw that recently with the Xerox HP tender offer, which they ultimately abandoned just given market conditions. So that's something to keep in mind. We like to execute a nice and tight merger arbitrage strategy that is leans towards friendly deals, and certainly only will consider definitive transactions. Because ultimately, what are we looking to accomplish in this strategy? Well, we're looking for a low volatility, low risk strategy that can generate consistent returns with low correlation to other asset classes. There's nothing wrong with, say, deal speculation. We call it pre-arbitrage or rumortrage, where perhaps there's a article in the news speculating on a potential buyout. Some people can generate good returns from that. However, you got to keep in mind that does introduce significantly more beta into the portfolio, and that's a type of strategy that can lead to significant losses in a market downturn, such as that we're having right now. So on to slide 11, I wanted to chat about consistent performance of merger arbitrage. What we have here is an asset return quilt produced by JP Morgan. There's a lot of data here. Specifically, I want to focus on one thing. What this data quilt shows is annual returns from 2009 to 2019 of various asset classes. And what we can notice is if we focus on the violet colored box, that is merger arbitrage. And the point here is that merger arbitrage is the only strategy that has had positive returns every year since 2009. If we compare it to the global bond portfolio, well, global bonds had 3 down years over this 10, 11-year period. We had 3 global equity bear markets over this period as well. So it's really something to consider, merger arbitrage, when thinking about it in a portfolio allocation sense. Whether it's something you want within your asset allocation, it's just really to consider the consistency of the strategy and the fact that, in years in which everything else is down, say as 2018, merger arbitrage, as shown through the HFRI merger arbitrage index, which is basically a composite of many merger arbitrage funds. 2018, it was the only strategy that was actually up. Even global bonds were down in 2018. Further dialing into those numbers, what I want to note here is that we look at annualized returns, and clearly between 2009 and the end of last year, global bonds had great returns, 10% annualized, nothing to sneeze at there. However, they did come with pretty substantial risk. We're talking about standard deviation of nearly 16%, leading to a return per unit of risk ratio of 0.64. So in order to earn that 10% annualized return, an investor had to withstand some pretty significant volatility, 3 bear markets, that's right, 3 instances of markets, global equity markets declining more than 20%. And as we go through this right now, investors realize that's not a very fun thing to go through. So that's something to keep in mind. And over that time period since 2009, global bonds only returned 2.5% annualized with a 5.6% standard deviation. If we compare those to merger arbitrage, which attained an annualized return of 4.1% annualized, nothing to write home about, but certainly a pretty decent return. However, if we take that in the context of its standard deviation of only 2.5%, its volatility, that leads to a return per unit of risk ratio of 1.64. That means on a risk adjusted basis, merger arbitrage had over twice the performance of global equities and more than 3 times that of global bonds. So it's really important in the context of evaluating annualized returns, and I see many in the media, they screw this up constantly, is you need to consider how much risk one is taking within a strategy and compare asset classes on a risk-adjusted basis. That's really, really important when benchmarking strategies. I like to consider merger arbitrage as a good fixed income alternative. If we look at the graph on the right, the blue line shows the HFRI merger arbitrage index, which is basically a composite of a number of merger arbitrage funds, the average net of fees performance of that strategy. So since 2009 did 3.7% annualized up to the end of 2019. We compare that to the Bloomberg Barclays Global Aggregate Total Return Index. Now what this is, that red line, that is what's known as the global bond portfolio. That's a global bond benchmark. Now that did 2.5% annualized gross of fees. So before fees, I think ETFs on that charge perhaps something in the range of 30 basis points or so. So that would bring the net return even lower. However, what we're looking at here in this chart is just note the consistency of merger arbitrage. Not only did it produce significantly better returns than the global bond portfolio, but it did it with more consistency and lower volatility. I wanted to discuss 2 additional key considerations, key advantages of merger arbitrage as a fixed income alternative. Number 1 is duration risk. So as interest rates go down and down and down, the interest rate risk of rates going up goes up and up, leading to very, very high duration risk. I hear that duration within, and what duration means is sensitivity to interest rate changes. I hear duration in some of these bond indices is at an all-time high, meaning bond investors are taking record risks with respect to potential rise in interest rates. So merger arbitrage really has nil duration risk. The average M&A trade is about 3 months long, so you can think of it more as a floating rate exposure. So duration is a key consideration and exposure to interest rates as well. The second thing is it's more tax efficient strategy because we can generate this consistent yield largely through capital gains as opposed to interest income produced by traditional fixed income like bonds. So those are two things to consider. Wanted to touch on more the concept of a fixed income alternative within a rising rate environment. So if we look at 3 years here, 2013, 2015, and 2018, these are years in which treasury yields actually went up. And the blue bar is the HFRI Merger Arbitrage Index, or the average merger arbitrage hedge fund, their return, net of fees. And the red bar is the global bond index before fees. So in 2013, treasury yields went up 130 basis points. You see merger arbitrage funds went up nearly 5% on average, and the global bond index dropped by 2.6%. We see slight upticks in treasury yields and interest rates in 2015 and 2018. The red bar, the global bond portfolio, fell, but merger arbitrage continued to rise, which really just shows its consistency and its resiliency if and when interest rates ever go up. So that's something to consider if you want to insulate that part of your portfolio from potential rising interest rates. Touching on risks, because risk is a main consideration here. I've always had the attitude that you keep your eye on the downside and the upside will take care of itself. So historically, it's somewhat analogous to a corporate bond portfolio. If you own a diversified portfolio of corporate bonds, you're going to have the odd default. The company will default and the bonds will trade down. Sometimes pretty precipitously, but that's just part of the game, and you need to you can't get around that. You basically need to diversify a portfolio to compensate for that, and that's where the merger risk premium really compensates investors for that. So if we go back historically, since 2011, and this analyzes all deals in the US, 94% of announced deals have closed successfully. So 6% of legitimate deals have broken, and on a broken deal, pretty much all the time, the stock will go down and an arbitrager will lose money in a deal break scenario. So ultimately, you're hoping that the 94% that do close on the terms more than make up for that deal break. However, 6% of that 94% is a unique situation in which the arbitrager is rewarded with additional consideration. Two things can happen there. Either shareholders can push for a higher consideration and the acquirer could agree to pay more, or an interloper can come in and compete for the target stock and push the price higher and higher. We saw that recently on a couple deals. One was Cincinnati Bell, in which both Brookfield and Macquarie competed and sent the price up nearly 50% from the initial friendly bid from Brookfield, and Macquarie went on to win that competitive auction process, richly rewarding arbitragers. And another recent one was Annixter International, where you had a strategic company come in over the top, offering a better consideration over what a private equity firm offered, and that one went up about 25% as this bidding war ensued. So that's something to consider. Is yes, there's downside scenario if a deal falls apart. However, there's typically an equal amount of upside scenarios in which arbitrager can get significantly more, and those tend to make up for the deal break. So that's something to consider, the concept of a bidding war and significantly more money for the target stock. Merger arbitrage as an asset class, it has become more popular. In 2019, it had north of 70 billion in assets under management, which was north of about threefold over the past 5 or 6 years. And it's a strategy that's really been standardized. It traces its roots back, 80 years ago. Like I said, Graham Newman partnership, they practiced it. Merger arbitrage funds started to get really popular in the go-go 1980s with the emergence of the leveraged buyout boom. But over the past few decades, returns have become more pedestrian as the strategy has become more competitive, more institutionalized, and more standardized, such that institutions are really demanding, low risk, low volatility, steadier returns. So it's a strategy in which you're not trying to shoot the lights out, but you're just trying to clip those steady single-digit annualized returns to give investors a pretty reliable source of yield. So it's becoming more popular these days. And now pure merger arbitrage funds manage north of $70 billion. I wanted to quickly touch on the notion of active versus passive. As we know in the long-only equity space, passive is just absolutely crushed active, such that the S&P 500 and other index funds now manage more than actively managed long-only mutual funds. And that's a trend that's only going to continue, just because passive, the S&P 500, you can get for very, very cheap. And it's just shown to just crush the vast majority of actively managed funds. So that's something to consider. However, there are passive benchmarks in other asset classes. One would be fixed income, which isn't nearly as possible because in fixed income, most active managers beat the passive benchmarks for a number of reasons. And that seems to be the case in merger arbitrage as well. If we look at the table here, we're comparing two things. One is the S&P Merger Arbitrage Index, which is the so-called passive merger arbitrage benchmark. Then we have the HFRI Merger Arbitrage Index, which is a composite of actively managed merger arbitrage funds. And as we can see, that over the long term, active, the HFRI Merger Arbitrage Index, has beaten passive, the S&P Merger Arbitrage Index, pretty significantly. And even, especially if we take fees into account, you can't get access to the passive merger arbitrage benchmark pre-fee. I believe there's an ETF in the US that offers exposure to this, but it charges about 75 basis points. So if we include that as well, then active has really crushed passive in the long term and short term in the merger arbitrage space. And there's a couple issues with market cap weighting. Market cap weighting works fabulous in long-only equities, as seen by the S&P 500's performance over the past 10 years. However, it does encounter problems in other asset classes. For example, in fixed income, market cap weighting bonds makes you exposed to the most heavily indebted companies, which generally is not great for returns. The same analog happens in merger arbitrage, whereas if you're market cap weighting to the largest deals, you are really being exposed to the most antitrust risk, such that if you have massive deals, typically there is the most antitrust risk, the most overlap. So that's really something to consider, the notion of or considering something as an alternative to the passive index in merger arbitrage, because historically it really just hasn't worked as compared to active investments. So prior to wrapping this up, I just wanted to really wrap up the portfolio construction. So we start with our security selection. That is going through the checklist that we went through, making sure it passes, all the deal terms, all the due diligence that we need to do, and then making sure it adequately rewards us for taking that risk. Then after that, once we have selected a security merger arbitrage investment for the portfolio, the second thing is position size. Like, how do you size a position? Well, what we like to do, we have strict position limits, smallest to largest position, and it's really the risk that you're comfortable in tolerating. So really, I advise people to have pretty strict risk limits and position size limits when executing a strategy, typically in the single-digit percentage range. The other thing is you look at how much can you lose on each position if a deal does break, and specifically on that goes into our position sizing as well. We like to limit the risk on any deal break to 2% of the portfolio. So if the deal does fall apart, the worst that you can expect in terms of result is a 2% drawdown, which isn't something that will ruin an investor. And number three is the notion of leverage. Merger arbitrage is typically a levered strategy. We like to run it between 150 to 200% on a gross basis. That's longs plus shorts. So say you're 120% long and 30% short to account for the shorts in the portfolio. That'd be a 90% net exposure and 150% gross exposure. And leverage really shouldn't be a target. Leverage is really something that falls out of the portfolio construction process, and it's something to keep an eye on, such that you don't get over leveraged, such that you have sufficient liquidity and things of that nature. And just commenting on the merger arbitrage space in general, there's typically 60 to 80 deals in North America at any one time. So by and large, there isn't a lot of differentiation between managers and merger arbitrage portfolios here. The way people tend to differentiate. It's not deal selection, but it's more so on the leverage side. If they want higher returns, they utilize higher leverage, but that just comes with higher risk. The other thing is that it's a strategy, as we've shown, that can be done in quite a systematic way, really through this 3-factor process that we've outlined throughout this presentation. Some people are asking, I saw in the chat, they're asking, is there any way to access merger arbitrage? Well, historically, it has been the realm of high net worth investors, such as family offices, institutional investors. It's really a staple of most institutional portfolios, call it 5% or so in terms of weighting a merger arbitrage in an institutional mandate. And those are typically offered through a limited partnership only to accredited investors. Like I said, for wealthy investors, typically high fee, generally 2% management fee, 20% performance fee. There can be high minimum investment, whether it be 7 or 8 figure amount, limited transparency. You might get liquidity of monthly, perhaps worse. However, there's this new concept of liquid alternatives. It's been around in the US for a number of years. However, it is new in Canada, just implemented last year, which has created the ability for all investors to access this asset class in a much more easy to use and less expensive fashion, either through liquid alternative mutual funds or liquid alternative ETFs, which is really a rapidly growing market, really bringing that endowment style asset allocation to all investors, not just billion-dollar endowments. It really leaves formerly inaccessible strategies like merger arbitrage open to everyone, which is really a great democratization of these strategies, which is a good thing. Lastly, I wanted to touch on outlook for merger arbitrage. I can talk about this more in the Q&A section. However, there's typically around 500 billion in outstanding M&A deals in North America. That's generally 60 to 80 deals, which is relatively constant. You have deals closing, new deals announced, etc. And that being said, I mean, there isn't much potential for yield-seeking investors to generate that yield through fixed income. You have the treasuries now yielding pretty much close to zero on the short-term basis, and even 10-year yield is roughly 70, 75 basis points. So you're not even really earning a real return. Adjusted for inflation, that's actually a negative return. So many investors are really struggling on where to generate that yield, especially without taking massive interest rate duration risk. So this is where a strategy like merger arbitrage can come into play. And what's interesting, if we know basically any asset class, aside from treasuries over the last month, with the coronavirus pandemic, COVID-19 spreading, you had this massive risk off situation. We have a global recession, and asset classes, many asset classes just experiencing basically record volatility. We had the S&P 500 trade down 35%, TSX down 38%, peak to trough. We had the VIX exceed 85 for the first time ever, which was volatility, the VIX being the fear index, volatility even higher than the worst days of October, November 2008, where many people were concerned that the financial system might blow up and never come back. And so that's the type of volatility that we're experiencing these days with this coronavirus-led market panic. And what that did, it's driven pretty exceptional spreads in all sorts of asset classes, whether it's high yield bonds, investment grade bonds, municipal bonds, and even merger arbitrage. If we look the graph on the right, what was typically a yield, average annualized return of the merger arbitrage universe that we follow between 4 to 6% before March 2020 has gone from about 5% to nearly 20%. It peaked at almost 23% annualized in late March. Since then, it's come down to a more pedestrian 15%, but I mean, that's triple of what it was 2 months ago, 1,000 basis points higher. And really, I've been following M&A since 2007 and investing in, hundreds of deals, perhaps thousands. And, this is the best I've ever seen it, comparable to 2008, but perhaps better. And it's just a kind of once in a generation buying opportunity, in my opinion. You can say that for a number of asset classes, whether it's, I'm not much of an expert on municipal bonds or investment grade credit. However, there are other investors that are seeing pretty tremendous opportunities. And as specialists in merger arbitrage, that is certainly something that we're seeing these days. It's where the market's pricing in many deals to break. However, we're just not seeing that if we look at the data, and I can get into that in the Q&A period. So really attractive outlook with annualized returns in the 15% range expected for merger arbitrage. So to wrap up the presentation today on merger arbitrage, really can present an attractive allocation, call it say 5% allocation within your asset allocation framework, a well-diversified portfolio for a number of reasons. We went over why and how it's been a consistently returning strategy. It does have a stable, low-risk profile and generates pretty steady yield, and it does that with low correlation to traditional asset classes. And depending on your tax situation, it could provide tax-efficient yield. And then commenting just on the current market environment with the equity bear market, the extreme volatilities really has led to the best opportunity set in merger arbitrage I've ever seen in my career. It's pretty significant. So that's another thing that investors should consider when looking at allocating to merger arbitrage. And that's about it for our presentation today. Hope you enjoyed it. I'll leave my contact information there, and I will get to questions. So if you have a question, please feel free to ask it. So I actually have a few, like in the double digits. So we're good, just trying to roll through these quite quickly. So the first one, generational opportunities typically mean that a lot of investors see more risk than opportunity. Why are they wrong? Well, what I wanted to focus here is on data, not fear. And this question actually relates to the second question I got that said, do you perceive that the current environment will cause more deals to fall through? If so, what perspective can you share? So let's look at the data. What's actually happening here? In March, when yields peaked at their highest at 23% annualized, the market was pricing in about 50% of deals failing. That's right, 50% compared to 6% historically. Now, with yields at 15%, the market is pricing in nearly 25% of deals failing. So if we look at the data, since February 28th, since the coronavirus crisis started, 27 deals have closed, while only 2 deals have failed. And one of those 2 deals was a hostile deal. So that's a 7% deal failure rate. I should say that 2 deals are on the ropes as well, but they aren't failed at this point. But nonetheless, the numbers are implying that the market estimates are way off, and it's just a liquidity driven panic that wasn't really representative of the economic reality. For a buyer to walk from a deal is incredibly difficult. Many people are wondering about material adverse change clause and such, and material adverse change clause has only worked once in the history of M&A of all time. That's one time, so not too concerned about that. So that's my thoughts on the massive dichotomy between reality and expectations. That's really where the opportunity lies within this asset class. Someone has a question about utilizing call or put options. I mean, you can do that. We don't really utilize options. I mean, you can sell calls on top of your stock, but that really reduces your upside. In a bidding war scenario, you can buy put options, but that really provides the same effect as just having a smaller position size. So there's many ways to structure these types of trades, and if you want to do it through options, be my guest. Another question, will deal flow dry up? Well, if we look at the numbers in terms of deal flow in January, 12 deals announced in North America. In February, there are 15. March certainly trailed off 9. We have not had any yet in April. So it's something to monitor, and it's not surprising that many acquirers, make their wallet shut when you have this massive bear market. There's not much for counter-cyclical buyers. The other thing is many targets may not want to sell when their stock's so low. So we are seeing somewhat of a decline in deal flow, but who knows how long that's going to occur. Had a recent deal announced, a gold deal in Canada. This was a couple weeks ago. So who knows, it's something to monitor, but thus far we have been seeing fewer and fewer deals announced over the past kind of 2-3 weeks. I don't expect this to be a long-term trend though. How does your investment strategy evolve over the life cycle of a merger from announcement to closing and in between? I mean, you basically look to buy early on to earn that yield, ideally hold until closing and get the consideration. As I indicated, some market participants like to market make on a spread, get in and get out, but I mean, you're really expecting to be smarter than the market there. There's nothing wrong with just buying and holding, earning that yield. As for what we do, another question is there a way to access merger arbitrage? Well, we did launch our Accelerate Arbitrage Fund today on the TSX under ticker ARB. So if you're looking for an easy ETF with low fees to get access to merger arbitrage, there's that option for you. And in terms of how we execute, we're not really market making in that one just because we are an ETF. So we just like to buy and hold positions in that one. Why do you think these arbitrage opportunities continue to exist consistently? Well, answer to that is just this merger risk premium to effectively, reward arbitrageurs for providing that liquidity, allowing long-term investors to exit at a profit, but keeping some of that profit for themselves. So it's really a risk trade-off compensation for taking on that deal risk. Another question, will you be focusing on certain sectors or will it be sector agnostic? This is a strategy that is very important to run with diversification on sectors. You don't want too much sector concentration because that can increase risks to the portfolio, as we're seeing right now in this whole Corona panic. Well, there's a lot of pressure on the commercial real estate and basically all real estate spaces, which over the past 10 years, that's been a pretty consistent asset class. However, 3 months ago, no one really expected this to happen. No one really expected everyone to be working from home. So it's really important to, from a risk mitigation, risk management perspective, to make sure you're diversified across sectors within a merger arbitrage portfolio and really have generally a diversified portfolio of merger arbitrage investments. Another asks, what's the best time to be trading this ETF, implying the Accelerate Arbitrage Fund? Well, basically for any ETF, you don't really want to buy in the first hour or sell in the last hour of trading, just because the bid-ask spread would be widest within those time frames. So I'd advise someone, if going to trade not just our ETFs but any ETF, wait an hour into trading. Just wait until spreads settle, volatility kind of settles for the day, and you can get a better price. Another question, how is the borrow cost affected to the short when a merger has been announced? It really depends on the size of the acquired stock. If it's large cap equity, there'll be no effect. However, if it's a small cap or medium cap stock, then that could cause the borrow rate to rise. So that's why it's important to get on your borrow quickly, get it locked up, and have good relations with your prime broker. Are there any liquidity concerns in entering or exiting relatively large positions in this strategy? Yes, certainly there's liquidity concerns in every strategy. You're hearing over the past month even liquidity concerns in the treasury market, which is the largest market on the planet. So there's always something to consider for all investors in all asset classes is, make sure that you don't have an asset liability liquidity mismatch. Make sure if you do have any sort of redemption terms that you can honor them within a fund structure. With real contingencies to deal closure, why would you say the experienced likelihood of deal closure is around 94%? What that means is that 94% has been, over the past 10 years, what we have experienced. This is what the data shows, that 94% of deals have closed and 6% of deals have failed. Obviously, past is not indicative of what's going to happen in the future. This just provides investors with a roadmap in terms of setting expectations on kind of the best estimate on an average go-forward basis of what we can expect. What is the most you can lose on any particular deal? Well, it's a really important rule that we have when running our strategy is we never go long a deal that has a buy side vote, meaning if the acquirer is issuing shares to buy the target, you see this quite often, is that certain exchanges, specifically I believe the New York Stock Exchange requires if they're issuing more than 20% of their equity, the acquirer is required to have a vote on their side. So the buy side, the buyer in the deal needs to have a shareholder vote. And this introduces pretty significant risks into an M&A trade, and here's why. The notion of having a buy side vote, in fact, puts the acquirer in play such that it leaves the acquirer exposed to a hostile takeover. And I see this every so often, basically once every year or two. And what happens here is an arbitrager would buy the target short the acquirer. And since the acquirer has to have a vote, this leaves a potential interloper the opportunity to come in, offer a significant premium to the acquirer. And what are the acquirer's shareholders going to do? Are they going to vote for the target deal, which probably made their stock go down, or are they going to vote for a massive premium sale to this hostile interloper? It's really a no-brainer. That hostile interloper's premium offer is going to break the original merger arbitrage investment, the pair trade that you put on as an arbitrager. So not only is your long position going to fall precipitously as the deal breaks, but your short position is going to absolutely rip your face off because now the acquirer is going to sell to a hostile interloper at a substantial premium. So those are the deals that can really kill an arbitrager. So we have a rule to never go long a deal with a buy side vote because it can lead to unacceptable kind of blow up risks, which we never want to do. As we indicated in our strategy, we limit any deal to a 2% loss. So say a deal has 50% downside, that would say, well, you can have a maximum 4% position because if it breaks, if it falls apart, and the small chance that it does, you're only going to lose 2% there. Another question, will we be able to get a recording of this webinar? Yep, we'll put it on our website, accelerateshares.com. We'll put it up there shortly. Many merger arbitrage funds are populating the portfolios with high percentages of SPACs. What a SPAC is a special purpose acquisition company. Please elaborate with your ETF. Yeah, one thing to consider, I believe SPACs, especially in this environment, offer a pretty attractive risk reward. How SPAC works is basically it's a cash-rich shell company. They don't have operations, they just own treasuries. And in certain market environments like the one they're in, they'll actually trade at a pretty decent discount to the treasury bonds that they hold. And what a special purpose acquisition company will do, it'll go out and buy a target company, and shareholders get to vote on that acquisition. And at the vote, holders of the SPAC can elect to redeem their shares to basically get net asset value, or what the underlying treasuries are worth. So you can earn an arbitrage spread by buying SPACs at a discount. There's another notion that you can get warrants in the SPAC as well that can provide further upside. So I am a big fan of SPAC arbitrage. We got to be cognizant of the low liquidity on SPACs. So they are a smaller percentage of our portfolio. So it won't be a majority percentage. It will be a smaller kind of low risk, low return, low volatility percentage. But we do like the strategy, but it's very important that, like I said, you don't have that asset liability mismatch. In an ETF, you have daily liquidity, so you got to be able to make sure that the underlying portfolio has sufficient liquidity. Also, the underlying portfolio liquidity can affect a bid-ask spread of an ETF, so that's something that we keep in mind as well. How are units in the ETF created? I don't want market impact when I buy. Well, the way an ETF works is you typically don't have market impact because ETFs have what's known as a market maker on the bid and the ask, also known as a designated broker. And so if you want to buy units of it, you buy shares in the market, and once a sufficient amount of shares are bought from the market maker, they go ahead and create a new unit. They create more shares, so it won't affect the market price. The market maker is there actively selling you shares, and when they sell shares, they basically create more assets for the fund. That's kind of how ETFs work on a quick and dirty basis. And that is it for questions for now. I'd like to thank everyone for joining the webcast today. Feel free to go on our website, accelerateshares.com. You can get a recording of this. Feel free to reach out with any additional questions. You can give me a call or email. And thank you so much. Hope you enjoyed it, and hope you have a great day, and good luck with your investing. Cheers.